It is 11:30 p.m. on a Tuesday. You should be sleeping, right? But instead, you are lying in bed, staring at the ceiling fan, doing that thing where you mentally scroll through your bank account and wonder if you're actually doing this whole life thing right. We have all been there. You have got some cash sitting there. Maybe it is from a bonus, maybe an inheritance, or maybe you have just been grinding and saving for 5 years, and you feel this heavy pressure to do something smart with it. You do not want it to just evaporate due to inflation, that silent thief that eats away at your purchasing power while you're busy buying groceries. So you start doom scrolling. One tab is open to a forum where guys with anime profile pictures are screaming that the economy is about to collapse and you need to buy gold bars and bury them in the backyard. The next tab is a real estate guru promising that if you just buy this specific 4-unit duplex in a city you have never visited, you will be retired on a beach in Fiji by next Tuesday. It is noisy, it is confusing, and honestly, it is paralyzing. My name is Mac, and I spend way too much time thinking about money, financial psychology, and why some people seem to glide through these decisions with total confidence while the rest of us are stuck spiraling in a cycle of what if I mess this up? It is fascinating to me, the way we attach our identity to our assets, how we treat a brick house or a shiny coin like it is a member of the family. We are not just looking for a return on investment. We are looking for safety. We are looking for a moat around our lives. But here's the thing about safety. It is expensive, and it is often an illusion. Today, we are going to strip away the hype. We are going to ignore the sales pitches, ignore the fear-mongering, and ignore the emotional attachment we have to dirt and metal. We're going to run the real math. We're going to look at gold, that ancient, shiny store of value, and real estate, that heavy, dirty, leveraged wealth builder, and we're going to figure out, once and for all, which one actually deserves your hard-earned money. And I'm going to warn you right now, the answer might not be what you expect. It is not as simple as one is good and one is bad. It is actually about understanding the math of time, leverage, and friction. Once you see the numbers laid out like this, it changes how you look at every dollar you earn. It takes the anxiety out of the decision and replaces it with a plan. So let's dive in. All right, let us start with the heavy hitter, the one your grandma probably loves. Real estate. There's this deeply ingrained idea in our culture that real estate is the only way to build real wealth. You hear at parties, you see it on Instagram. God is not making any more land, right? It feels right. It feels tangible. You can drive by it. You can touch the walls. You can paint the door bright red if you want to. It feels safe because it is physical. But when we start doing the real math, we have to look past the feeling and look at the mechanics of how money actually grows here. The biggest, most powerful weapon in real estate is something called leverage. This is the cheat code of the wealthy. And I do not use that word lightly. It is literally a mathematical advantage that you do not really get with other assets. Let me break it down simply. Let us say you have $50,000 to invest. If you want to buy gold, you buy $50,000 worth of gold. If gold goes up 10%, you make $5,000. That is great. Simple. Clean. Now let's look at real estate. With that same $50,000, you can typically put a 20% down payment on a $250,000 property. You own a $250,000 asset. You control $250,000 worth of value with just your 50 grand. Now, let's say the market moves in your favor and that property appreciates by 3%. Wait, 3%? That sounds boring compared to the stock market or crypto, right? But hold on. 3% of $250,000 is $7,500. You just made $7,500 in appreciation on your $50,000 investment. Do the math on that. That is a 15% return on your cash. You made a 15% gain while the asset only grew by 3%. That is the magic of leverage. You're using the bank's money to magnify your returns. And that is just the appetizer. The main course, the thing that really makes real estate the wealth-building machine for so many people, is amortization. You know, the monthly mortgage payment is annoying, sure. It is a bill you have to pay every month. But a portion of that bill, specifically the principal portion, is not really an expense. It is a forced savings account. Every month, when you pay that mortgage, your tenant, if you're renting it out, or use paying down the debt. You owe less today than you did yesterday. So let us recap the first 3 years of owning this hypothetical $250,000 property. You put in $50,000. The property goes up in value by 3% a year. That is about $7,500 a year in appreciation. Plus, your tenants are paying down your mortgage. Let us say in the first year, they pay down $3,000 in principal. So, in year one, your equity grew by $7,500 appreciation plus $3,000 paydown. That is $10,500 of growth on a $50,000 investment. That is a 21% return. And honestly, that is a conservative year. You show me another vehicle where you can reasonably expect 21% compounding returns with relatively low risk. It is hard to beat. But, and this is a big but, we have to talk about the stuff nobody likes to talk about on the glossy YouTube thumbnails. We have to talk about the friction. Real estate is a high-friction asset. It is not just buy property, get rich. It is buy property, pay closing costs, pay inspection fees, fix the HVAC that breaks 3 days after you move in, paint the walls because the previous tenant loved the color neon green, deal with a tenant who stops paying rent, pay property taxes, pay insurance, pay landscaping. I had a friend, let us call him Dave. Dave bought a duplex. He thought he was a mogul. He was going to retire at 40. 3 months in, the sewer line backed up in the basement unit. Do you know what a sewer backup looks like? It is a horror movie. It cost him $12,000 to fix. That wiped out 2 years of his profit instantly. He was on the phone with the city. He was calling plumbers at midnight. He was stressed out of his mind. This is the math of misery. When you calculate returns on real estate, you have to factor in these costs. The 1% rule people talk about, where your rent should be 1% of the purchase price, is often a fantasy in many markets today. If you are buying a property that yields $1,500 a month in rent, but your mortgage is $1,400 and taxes are $200 and insurance is $100 and repairs average out to $200 a month, you are not cash flowing. You are losing money every single month, hoping for appreciation to bail you out later. That is not investing. That is speculation with a leaking toilet. So, real estate wins on leverage and forced savings, but it takes a heavy tax on your time and your sanity. It is a part-time job that you did not apply for. Now, let us pivot. Let's walk across the room and look at the shiny stuff. Gold. Gold is weird. In the world of finance, it is the outcast. It does not pay dividends. It does not produce cash flow. You cannot live in it. If you buy a gold bar and lock it in a safe for 20 years, when you take it out, it is the exact same bar. It did not do anything. It did not work for you. It just sat there looking shiny. From a purely mathematical, productive asset standpoint, gold looks terrible compared to real estate. Warren Buffett famously hates gold. He says if you take all the gold in the world, it would fit into a cube about 67 feet on each side. You could look at it, touch it, but it would not feed you, keep you warm, or do anything for you. He would rather buy all the farmland in America, which produces crops and income. But that perspective misses the psychological role of gold. Gold is not an income play. It is an insurance play. It is the anti-fragile asset. Let's look at the long-term math. Over the last 50 years, gold has actually performed surprisingly well. Since the early 1970s, gold has gone from around $35 an ounce to over $2,000 an ounce at various points. That is a massive increase. But here is where the real math gets interesting. Inflation. People forget that the dollar in your pocket is a melting ice cube. In 1970, a median house cost maybe $23,000. Today, it is over $400,000. Gold was $35. Today is around $2,000. Give or take, markets move. Let us run the numbers. $23,000 to $400,000 is roughly a 17x increase. $35 to $2,000 is roughly a 57x increase. Wait, look at that. Gold actually outperformed residential housing prices on a raw multiplier basis over that specific 50-year period. Now, this is not a perfect comparison because we're not factoring in the leverage on the house or the rent you collected, but it busts the myth that real estate always goes up faster than everything else. It is not always. The real math of gold is about purchasing power preservation. When the stock market crashes, when real estate bubbles burst, when currencies devalue, gold tends to hold its ground. It is the chaos hedge. But we have to be honest about the friction here too. Gold is surprisingly annoying to own and transact with. If you buy physical gold coins or bars, you have to store it. If you keep it at home, you're risking theft. You literally have to buy a safe, bolt it to the floor, and hope nobody breaks in. That is a cost. If you keep it in a bank box, you are paying annual fees. And when you go to sell it, you do not get the spot price. You get the bid price, which is lower. Dealers charge premiums. You buy at retail, you sell wholesale. That spread eats into your returns immediately. Let us say you buy a gold eagle coin. You might pay 5% over the spot price. When you sell it, you might get 2% under the spot price. So, right out of the gate, you're down 7%. The price of gold has to go up 7% just for you to break even. Compare that to selling a house. Yes, you pay 6% to a realtor. Hi, I know. But the house likely appreciated way more than 7% during the time you held it. There's also the opportunity cost to consider. This is the invisible math that hurts the most. If you have $100,000 sitting in gold coins in a safe, that money is dead. It is not working. If that same $100,000 was in real estate, it is not just sitting there, it is throwing off cash flow every month, which you can then reinvest. That is the velocity of money. Real estate allows your money to move, to spin, to compound faster because the asset itself generates more fuel. Gold is just fuel sitting in a can. It is valuable fuel, but it is not generating anything new. So, how do we decide which one wins? We need to look at the utilization math. This is the part of the equation that depends on who you are. If you're young, you have a high income, you have energy, and you have time, real estate is the clear mathematical winner for you. Why? Because you can afford the friction. You can fix the toilet yourself. You can deal with the tenants. You have the 30-year time horizon for the compound interest of leverage to work its magic. The math of leverage is so powerful that it usually beats the static appreciation of gold, provided you survive the headaches. The real kicker with real estate is that you can refinance your wins. This is a strategy rich people use all the time. You buy a house, the value goes up, you refinance the loan, pull out tax-free cash, and buy another house. You keep recycling your equity. You cannot do that with gold. Your banker is not going to give you a loan against your gold bar at a low 4% interest rate to buy more gold. They just will not. But they will do it all day long for a rental property. However, if you're older, or you have a high-stress job, or you just hate dealing with repairs and people, the math changes. The utility of the money shift from growth to peace of mind. Let us say you're 60. You're looking at retirement. Do you really want to get a phone call at 2 a.m. about a broken water heater? No. You do not care about 15% leveraged returns anymore. You care about not losing what you have. In this scenario, gold acts as a stabilizer. It is ballast for the ship. Think of your portfolio like a ship. Real estate is the sail. It catches the wind and pushes you fast. But if the wind is too strong in a booming market or the storm hits in a crash, the sail can tip the boat over or tear apart. Gold is the heavy lead weight in the bottom of the boat, the keel. It does not make the boat go faster. In fact, it weighs it down a little, but it keeps you upright when the waves get crazy. The real math is not about picking one. It is about the correlation. Here is a fascinating mathematical truth. Gold and real estate often move in opposition to each other, or at least react differently to the same economic trigger. When interest rates are low and the economy is booming, people flock to real estate. They borrow cheap money. They buy houses, prices soar. Gold usually sort of sits there or dips because people are feeling optimistic. Who needs gold bars when I'm flipping houses for profit? But when things get ugly, when inflation spikes to double digits, or when the stock market crashes, or when banks look shaky, real estate gets hammered. Why? Because rates go up to fight inflation, making mortgages expensive. Houses become unaffordable. The market freezes. In that exact same moment, gold wakes up. It rockets up. Because when people lose faith in the economy and the currency, They run to the one thing that has been money for 5,000 years. So, if you own 100% real estate, you are exposed to interest rate risk and liquidity risk. You are house rich, cash poor. If the market crashes and you need to sell your house to get cash, you are in trouble. It takes months to sell a house. You're desperate. You have to accept a low offer. It is a mathematical nightmare known as forced liquidation. If you own 100% gold, you are exposed to opportunity cost risk. You miss out on the magic of compounding, leverage, and rental income. You protect your money, but you do not grow it as aggressively as you could. The winning math is a hybrid. This is where I personally land after staring at spreadsheets until my eyes hurt. I like the idea of using real estate as the engine of your portfolio. It does the heavy lifting. It is where the wealth comes from. You use good debt. You buy in decent areas. You treat it like a business. You let the tenants pay off your mortgage while you sleep. Then you take a slice of the profits, say 5% to 10%, and you rotate it into physical gold or gold ETFs if you want less hassle. You are not trying to hit a home run with the gold. You are just building a disaster fund. It is like building a fire. Real estate is the big logs. They burn for a long time. They produce a lot of heat. Gold is the lighter fluid and the kindling. It helps start the fire, and it keeps a reserve of fuel nearby in case the logs get wet. But you cannot heat a whole house with just lighter fluid, and you cannot start a fire with a giant wet log without some help. I want to share a quick observation about human nature here, because this affects the math more than people realize. We tend to overestimate our ability to handle risk when the market is going up. When you see your neighbor making a fortune flipping houses, you feel stupid for holding gold. It feels like you're missing out. That is FOMO, fear of missing out. And FOMO causes you to buy at the top. Conversely, when the market crashes and gold is the only thing going up, we feel like geniuses for a week, but then we get greedy. We think, gold is going to $10,000. I should sell my house and buy more gold. And that is usually when gold tops out. The real math requires you to be a robot. It requires you to buy real estate when nobody wants houses, like in 2010, and buy gold when nobody thinks we need it, like in 2015 or 2016. You have to do the opposite of what your emotions are screaming. That is so hard. It is brutally hard. My name is Mac, and I struggle with this constantly. I want to follow the herd. It feels safer, but the herd gets slaughtered. Let us look at a specific scenario to wrap our heads around this. A stress test. Scenario A. You have $200,000 all in real estate. A recession hits. You lose your job. One of your tenants moves out and trashes the place. You now have a mortgage payment due, repairs to make, no income, and no cash. The bank is calling. You are forced to sell the property at a loss. You lose $50,000 of your net worth in a panic. That is the trap of illiquidity. Scenario B. You have $150,000 in real estate and $50,000 in gold, or cash equivalents, which gold mimics in liquidity. The same recession hits. Your tenant trashes the place. You are stressed, yes, but you have that $50,000 in gold. You can sell a portion of it instantly. You write a check for the repairs. You cover the mortgage for the 2 months it takes to find a new tenant. You survive the storm. You keep the property. You keep the equity. In scenario B, the $50,000 in gold made you way more money than if it had been sitting in a savings account earning 0.5%. It saved you from a catastrophic loss. That is the math of survival. Preserving your capital is just as important as growing it. So which wins? If we're talking strictly about maximum wealth accumulation over a 30-year period, assuming you are a savvy, active investor, real estate wins. The leverage is simply too powerful to ignore. The ability to control a large asset with a small amount of money, combined with tax benefits like depreciation, creates a return on investment that static gold struggles to match. Gold is a defensive player. Real estate is an offensive player. You need a team that can score, but if you have no defense, you lose the game. Here is the final piece of advice, the actionable takeaway I want you to grab hold of. Do not look at this as a fight. Do not be team gold or team real estate. Be team math. If you're just starting out and you have maybe $10,000 or $20,000, honestly, neither might be the right move yet. $10,000 is barely a down payment on a decent property and is a tiny amount of gold. You might be better off in a broad stock market index fund, which offers liquidity and decent growth without the headaches of a toilet or the storage fees of a vault. That is the boring answer, but it is often the right one for the accumulation phase. But once you cross that threshold where you have serious capital, 50K, 100K, 500K, that is when you build the Tulane Road. You build your foundation with real estate. You use the bank as money. You find that cash-flowing duplex or that small rental house. You accept that it is a job. You treat it with respect. And then on the side, you start stacking a little pile of gold. Maybe it is just one coin a month. Maybe it is 5% of your income. You tuck it away. You do not look at it. You do not trade it. You just let it sit there as your screw-you fund against the world going crazy. The math tells me that real estate builds the mansion, but gold buys the alarm system. You need both if you want to sleep well at night. We spend so much time looking for the perfect investment, the one golden ticket. But the truth is, the perfect portfolio is boring. It is a mix. It is diversified. It is unsexy. When I look at my own finances and the finances of the truly wealthy people I have studied, they rarely have 100% of their net worth in one thing. The guy who owns 40 apartment buildings, he usually has a pile of gold or gold mining stocks tucked away somewhere. The guy who hoards gold, he usually owns a paid-off farm or a rental property or two. They understand that the economy is a cycle. Winter always comes. Summer always comes. You dress for the season you are in, but you keep a coat in the closet for when it changes. So, stop agonizing over which one is better. Ask yourself better questions. Ask, how can I use leverage safely? Ask, what would happen to my life if the stock market cut in half tomorrow? Ask, do I have the temperament to be a landlord? Answer those questions honestly, and the math will start to make sense. You will stop trying to beat the market and start trying to master your own situation. Look, we covered a lot of ground here. We talked about leverage and forced savings and the hidden costs of toilets and storage fees. We stripped away the romance of the gold bug and the real estate mogul and looked at the raw numbers underneath. The biggest takeaway, the one thing I really hope you remember when you close this video and go back to your life, is this: math is neutral, but how you use it is not. The math of leverage can make you rich, or it can bankrupt you. The math of gold can protect you, or it can stunt your growth. The difference is your behavior, your discipline, your ability to stick to a plan when everyone else is panicking. Real estate wins on growth and utility. It builds the castle. Gold wins on stability and preservation. It protects the kingdom. You do not have to choose one forever. You can pivot. You can start with one and move to the other. The goal is not to be a real estate investor or a gold hoarder. The goal is to build a life where you're not worried about money. So, take a look at your situation today. Are you too exposed to one side of the ship? Maybe it's time to balance it out a little. Maybe it is time to finally look at that rental property, or maybe it is time to buy your first few ounces of silver or gold. Whatever you decide, make sure the decision is based on your numbers, your tolerance for risk, and your goals. Not because some guy on YouTube told you the world is ending. You have got this. It is just math. And math is something you can learn, something you can master, and something you can use to build the exact kind of life you want to live. Thanks for hanging out with me, and I will see you in the next one.